Imagine the satisfaction of owning a rental property, building wealth, and creating a stable income stream. It is an exciting prospect, offering many rewards. But with that excitement also comes the practical reality of managing the finances, especially when it is time to consider your taxes. Rental income significantly affects your taxable because the Internal Revenue Service generally considers it ordinary income, just like wages from a job. However, the good news is that you do not pay tax on every single dollar you collect. Instead, your tax liability is based on your net rental income, which is your gross rental income minus all of your allowable expenses. The core reason this system works is that the government recognizes the costs associated with earning that rental income. This means that many of the expenses you incur while operating your rental property can be deducted from your gross income. Think of things like mortgage interest, property taxes, insurance premiums, necessary repairs, utilities, advertising costs, and even professional property management fees. One of the most powerful deductions, often overlooked by new landlords, is depreciation. This non-cash expense allows you to recover the cost of the property and any improvements over their useful life, reducing your taxable income without a direct cash outlay. To effectively manage your rental property's tax impact, meticulous record keeping is absolutely essential. Set up a dedicated bank account and credit card solely for your rental property to keep finances separate and easy to track. Document every single income payment received and every expense paid, keeping receipts and invoices organized throughout the year. When tax season rolls around, you will report this information on Schedule E, Supplemental Income and Loss, of your federal income tax return. This form helps you calculate your net rental income or loss and flows that information into your overall tax picture. It is also important to understand specific nuances like the passive activity loss rules. Generally, if your rental activity results in a loss, you might be limited in how much of that loss you can deduct against other income. However, if you actively participate in your rental business and your modified adjusted gross income is below $100,000, you may be able to deduct up to $25,000 in losses against your ordinary income. This provides a significant tax advantage for active landlords, but this deduction begins to phase out for incomes between $100,000 and $150,000. By proactively tracking your income and expenses, understanding eligible deductions, and consulting with a qualified tax professional, you can significantly reduce your tax burden. This approach allows you to maximize the financial benefits of your rental property and confidently navigate the complexities of real estate investing, turning your investment into a truly profitable venture.